Hey everyone, it's Gerald and welcome back to another video. Today, I'm going to talk about how you can buy discounted stock on Moomoo using put options. You're looking at a huge discount like 15, 20 or as much as 25% discount off its current market price. Of course, there are downsides to it. I'm going to explain briefly how options work, the pros and cons of this particular method. In particular, we are using put options to buy stocks at a discount. With risk, what are the risks, how to mitigate some of the risks so that you get, most of the good and very little of the bad. And I'm going to show you like a live example because I do want to buy or underwrite an option to buy a stock at a discount, and I'm going to show you my hypothesis for it very briefly as well. So let's begin. First thing I'm going to do is show you my Moomoo app. So pop it up. Okay, so I'm in the quotes page, so I go over the trade. As you can see, I've already converted my Singapore dollars to my US account. So if you look at the transaction history, I've actually sold the free Apple share which I've gotten. So if you want to be a sponsor, quote unquote sponsor of this channel, please use my promo code, create a new account, you get one free Apple share. It helps this channel out, so thank you so much if you decide to support this channel and be a sponsor. And apart from that, I tried doing like a spread. It doesn't work, so Moomoo, you can't do spreads, but you could sell covered puts, which I did for the company that I'm looking at, which is Shift, and I collected $50 in premium. So you can't see it now, you may not understand it. So very quickly, I'll run through how options work. In order to go to the options page, first you need to go to US, quotes. I'm going to go to my company, which is SFT, Shift Technology. And scroll to the right, you see options, right? So options, so the current market price of Shift is $8.80. So when it comes to option, the important thing to understand is that one option equates to 100 shares. So while Shift stock is $8.80, when you trade a contract, you're looking at 100 times $8.80, which is $880. So you better make sure you have that amount of money just so that you can mitigate all the downsides. So in this case, we are looking at only put contract. So put contract means that the buyer or the person that has the rights to the put contract is able to put or force sell the shares to someone. So in this case, what I'm doing is to underwrite a put contract. So I give up my rights so that if the stock goes below a certain amount, I have to buy the stock. Okay, so in return, that person pays me a premium. So I collect that premium as cash upfront, which is really fantastic. So let's look over all the put option, and right now they have an option for 16th of July as well as the 20th of August. Okay, so 20th of August is 50 days, 16th August is about 20-ish days, right? A good rule of thumb when it comes to trading options is that you want to look at options that are about 45 to 60 days so that the decay basically the option premium would expire rapidly. So the goal of this, right, of this strategy is that you want to collect extra cash and use that cash to subsidize the purchase of your stock. So now I'm going to very quickly run through why I think Shift is a great company to own and how does that play into this option play. Okay, so Shift is basically second-hand online car sales company. Basically, people can buy and finance their car purchases online, and currently they're very active in one state, which means they can potentially grow to a lot of states. So it is a small company with a market cap of 800 million compared to its peers of as much as $50 billion. So it's a small company, which means high growth potential, but at the same time there's a lot of risk. So what's really great about this company is that in terms of reviews and the way that they construct their business, right, the trust score and based on customer reviews, that they basically love this company a lot more than their two other competitors, which is Carvana and Vroom. And in terms of growth rates, they are also one of the faster ones in growth rates. But they have a big problem. So it is cheaper to buy this company relative to its peers in terms of price to sales ratio because it's not profitable yet, and that's where the big problem lies, right? This company is not yet profitable, and with its current cash burn rate, it has to be able to become profitable within 3 years. Otherwise, they have to raise more capital, and if they grow faster, costs increase even more, they burn cash faster, they may go bankrupt. So that's the big risk. But because of this company's business model, they have basically built an advantage compared to the two bigger companies in this industry. So that's why they're growing faster. Customers love them more compared to their peers. So hopefully this company can 10x, but there's also risk to the downside. But I think it's mitigated by the fact that bigger car companies would be interested to acquire this company for cheap. So the average analyst buy price is $13.50, but right now this company is $8.80. So I think the risk at best, I'm thinking it's about half the price, but the upside is a lot. You're looking at 10x kind of upside. So just to state, if this company goes bust and it goes bad and you decide to follow my trade, don't sue me, okay? Disclaimer upfront. Okay, so now that I got kind of the brief idea of the shift company out of the way, let's talk about the option. So in this case, if I were to sell a put option for 750, right? You're looking at a spread of 0.4 to 0.5 cents. And what this means is that if I underwrite an option for 750, let's just follow the ask price. Basically, someone has to pay me 5 cents per share, with me promising that if the share goes below 750, I will buy one share from you at 750. And at 880, I think it's a discount. At 750, it's a no-brainer. I will definitely buy shift at 750. So by offering that, basically what I'm saying is that for every share, right, I'm willing to pay 5 cents for it. So remember that the option contract is for 100 shares. So if each share is 5 cents, 100 shares is 5 cents, $5, $50. $50. So basically I get $50 upfront with the promise that if the share goes below 750, I provide the insurance, I will buy 100 shares for 750 each. Then this begs the question, right? The downside is, what if shift actually do explode and become a 10x company? How? Then that's the problem. As an underwriter, you kind of lose all the upside. In return, you get a nice catch up front from this, and you protect a lot of downside, which is $750 of maximum loss. You protect it, but this can be mitigated by the fact that if you really want to own the stock, let's look at all the way at the highest strike price that you can get, which is $20. So if you were to buy or sell an option with a strike price of $20, which means you promise that by 20th of August, you will buy shift for $20 per share, but bear in mind, the person has to pay you $11.50 in cash upfront as insurance premium. And judging by the look of this company with the share price over here, it is very unlikely that this stock, okay, let's just go over to the quotes. So if you look at the quote, it has never breached more than $11, and within 50 days, is it going to breach like a $20 mark? In my opinion, I think it's very unlikely. But if you really want to own the stock, you can go ahead and sell at a very high strike price, in this case $20, and collect at $11.50 premium, which brings your average cost down to about $8.50, which means you save 30 cents per share in terms of discount. And 30 cents, let me just calculate very quickly. So a 30 cents discount off the current market price equates to a discount of about 3.5%. So you get basically a 3.5% discount to buy the share, and you get a nice $11 in cash up front for you to do what you want with it. So it's basically leverage. But of course, when you buy a share, make sure you have enough cash on hand. But bear in mind that when you do options, you're dealing with 100 contracts, and you want to make sure you have enough cash to support the entire transaction. So otherwise, you'll be leveraging, and that's risky. So in this case, if you're going for the maximum because you really want to own the share, and chances are you probably own the share at $20, if you were to sell a put for August, you would need to prepare $2,000 cash in hand, and you get an additional $1,100.50. So that brings your account to about $3,000. So don't spend the entire $3,000. Make sure you have $2,000 in hand so that you can actually buy the stock when August comes. So again, if this stock rises to like $40 by August, then you lose a lot of the upside, and if it goes down, you actually have to bear a lot of the losses. And you can see this is where the risk reward comes in, right? But in this case, because I value it as a very valuable company with a maximum lowest price of $4, so I think that it is a very good buy at this price. So you can see the pros and cons of this. But if you integrate this with your investment methodology, knowing that you really want to buy this stock, you can actually buy a stock at a discount. So in this case, because I've already bought 100 shares for this, I don't mind buying a little bit more, but I do not want to pay a high price for it. So I'm willing to pay $7.50 if it goes down to that price, because that's an even better bargain. It's like a good 20% discount off its current price, which is a fantastic deal. So I'm going to go ahead and sell a put option, right? So I'm going to sell. Yeah, so now I'm at the option page on Moomoo platform. I'm going to look at the price. So it looks like the option price has been steady. Yeah, it barely moved at all. It only moved from 45 to 46 cents today. So it looks like I won't be getting $100. So I'm selling. So if I sold one option, it's $45 minus the option fee, which is about $2. I just rounded up to $2. So I'm getting $43. I'm gonna unlock trade. I'll type my password. Yeah, so in this case, after you set your price, I'm going to set 46. I'm going to sell. Continue. So they will give you a warning that this is a short position. So in the event it goes down, I have to cover the losses. So let's see. Is anyone? Yeah, no one seems to be executing. We'll wait a couple of minutes, see how it goes. Okay, so for the sake of this video, I'm going to just really bring down my price. So don't do it if you have the time, because it's really not good to reduce your margins just because of this. There we go. So the order was filled at 41 cents finally, and this means that I've collected 41 cents times 100, which is $41 in cash, and I have to honor the contract of $7.50. So in the event that you do not have cash, you would be basically margin called by the broker. The broker will force you to pay up to be able to honor the contract, but usually before that happens, you would probably be forced to close your position at a huge loss. So always make sure you have enough cash to do this thing called a covered put. So if you're from the future, let me know how this trade went, whether I made money, I earned that $41 or not. But more importantly, I hope this is a good video to give you insights to like using options as a strategic investment method rather than as a trading tool to buy stocks at a discount. Can you imagine I paid like $2,000 in an investing course and I learned this, which is kind of a good deal, right? So, and I'm sharing it with you for free, so do give me a thumbs up if you kind of found this video helpful. And more importantly, when it comes to option, right, there's different type of options like the European options and the US options, and they work differently. So in this case, we are looking strictly at US stock options, so just bear that in mind. And with that said, if you're using a Tiger account, you can't sell option, and this is one of the reasons why I love Moomoo, because Moomoo allows you to sell or underwrite options to buy options at a discount and use it sort of like as a strategic stock buying method. So if you haven't opened a Moomoo account, check out the referral link in the description below. It gives this channel a small kickback. And if you haven't opened a Tiger account, they have some really fantastic deals going on over there. I made a video sharing how I try to redeem all my vouchers, because when you buy or get vouchers on Tiger, there is some sort of a trick to it. So you want to check out the video, check it out over here if you have free vouchers. If not, check out what YouTube recommends you over here, and I'll see you next time. Take care, everyone. Don't know why I get particularly jittery when I try to make videos at night. Is it because it's 12 AM right now? Perhaps.